Take a look at gold here, guys. So we know gold was on the verge of a breakout. We had a high pivot here from 2020, high pivot 2022, 2023. Yesterday, when gold opened, it had this God candle, as the new term is, where it just shot ridiculously higher, getting basically above $2,150. Now, what ended up happening here? So basically, what happens is, and when you get these big pops, what's essentially going on is that there are a lot of short stops on gold. Now, I've always been saying, guys, gold is awesome. Gold is going to be a top performer. But what happens is when you go through that all-time high, there's a certain amount of stops for shorts that are triggered. Now, this pop in gold occurred basically last night when the S&P futures opened, when the gold futures opened. In other words, the volume was almost non-existent, right? So when there's no volume and you have a bunch of shorts that are triggered, it's going to cause a massive oversized move. That is not a normal move for gold, guys. Now, the kicker is this, is that number one, we had an inverse head and shoulders here that I've talked about quite a bit. We were above it, but to trigger the inverse head and shoulders, you must, and I repeat must, get a daily close above the neckline. What's the neckline here, folks? This white line. Well, right now, we are not above the white trend line. Therefore, you have not triggered the head and shoulders just yet. We have to watch and see where this ends today. If it ends below, there's no trigger. Not only that, but one of the very things we have to be aware of, and I'm just a technician here, I am someone who dissects the data, but if we end where we currently are, what candle formation is this, guys? What candle formation is this on the chart? And this would be a topping tail. And a topping tail is a reversal signal. Now, by the way, does this mean that, oh, gold is going to collapse back down and no longer break out? No, it doesn't mean that. What it means is you actually could be setting up for at least some sort of pullback off of this level. Like, for instance, we know we've had a pretty remarkable bull run on gold, right? I mean, all the way up there. So to be honest, if it were to pull back here around 2,000, that would be very normal. There's also upsloping trend lines that can be connected right in that vicinity. So I would not be surprised if gold has a pullback to about the $2,000 level at this stage over the next, let's say, week or two. That could also coincide with the dollar gaining strength, maybe yields starting to bounce up. Now, in regards to yields, let's talk a little bit about Friday. The markets had a good rally, but Jerome Powell was actually pretty hawkish. I think the rally on Friday, and this is very common, if you look at the data, again, everything's about data, you have to understand that the data dictates that you see the first of the month, which was on Friday, new money flow coming into the markets. And so even with the hawkish kind of statements from Jerome Powell, the market basically pushed those aside and rallied up as new money flow came into the market. Now, interestingly enough, and we'll talk a little bit about this when we go to the S&P chart, we are seeing a pullback today. Now, remember what I said on Friday, and we're going to go to the S&P in just a minute, is that yesterday, or I should say Friday, the bulls maintained control. All right, remember, we had that reversal candle a couple days prior. We didn't get follow through, and the markets then ultimately pushed up. The bulls are still in control. But when we're extended like this with key stocks starting to roll over, I'm continually watching for where the bears begin to gravitate and take control again. And I'm watching like a hawk for this. Okay. Couple other charts here before we flip over. Natural gas continues to go lower. So again, natural gas, this has been a stumper for me personally because I was convinced we would at least see some sort of bounce off of this area. All we got was a two tiny green candle here, and then it broke lower. Now the positive is this on natural gas, and I'm going to tell you, this is why I'm adding today to my natural gas position. The reason I'm adding is, number one, we now are hitting and piercing the 200 moving average. Might be hard to see, but there's a blue line down here with the 200 moving average. And number two, this is probably the bigger one, and I'm going to take the 200 moving average off. But the bigger factor now is that if you do a Fibonacci retrace from the lows to the highs, look at what natural gas is hitting. Natural gas, and I can zoom in a little bit more on this chart, all right? Natural gas is now hitting exactly today the Fibonacci 618 level. Now, again, that's my favorite Fib retrace. I love the 618. I find it to be the most powerful of all the retraces on a Fibonacci basis. So we're now into the daily 200 on natural gas, and we're into the Fibonacci retrace. Now, by the way, this is a great example where I can learn to teach, or I could teach you guys about how my mentality works. What I do when I started a position on natural gas up here, I only started a tiny position. With members at Verified Investing Alerts, what was it? 1% of portfolio. That's it. Why? You might say, well, why? You thought you'd get a bounce here. Why would you just do 1%? Because at this stage of me trading, I understand that I'm going to be wrong a fair amount of times. Markets don't have to stop where I think they're going to stop. It's technical resistance or support, but it's all probability based. So if you have a 70% chance of a bounce here, guess what? There's still 30% chance it goes lower. So if it goes lower, you have to leave yourself opportunity to dollar cost average. Eventually, you're going to get a bounce, right? I mean, it's a commodity. You're going to get a bounce, but you don't know if it's here or if it's here or if it's at the 618 here. One of these levels will give you a bounce. Therefore, you dollar cost average in at the technical levels, building your core position so that when you get the bounce, boom, you're basically very little out of the money. You go right into the money and make money that way. All right, very cool as well, guys. Again, I love this kind of educational stuff because I think what it shows you too, folks, is that because everything I do is probability based, there's going to be plenty of trades that, at least probably 3 out of every 10 trades that we talk about that will not play out the way I think they're going to play out. The question is, how do you maneuver so that you can still ultimately break even or make money on them? And that's the key.